Have a nice day to all of you. So today I'm going to talk with you about another important topics. Right after having idea about the production theory, so that we already covered under the microeconomics, the things that we have to concern, introduction, the demand and supply, consumer behavior, under consumer behavior, the marginal utility theory and the indifference curve theory. Then after having idea about that, we already moved to identify the producer behavior. Right? Producer behavior, and the producer behavior also that you already have idea about the production theory. Production theory, then you all know being a rational consumer. Right? Being a rational consumer, the rational consumers wants to maximize their utility with the limited money income. So likewise, being a rational producer, so they also want to maximize their profit with the limited cost, right? While minimizing cost. Right? So therefore, that each and every supplier should have good understanding about how they control, or how they mitigate, or how they minimize their costs. So that's why that we are going to now learn about the theory of cost, or the concept of cost behavior. So that under this session, I wish to cover with you that I just want to introduce the concept of cost, then the what does mean by the cost, then the different types. So there are different type of costs based on nature, based on the time dimension that we classified. Different type of costs, and also along with that the behaviors of cost curves which relate to the short run and which relate to long run. Then those are the things, because being a producer, that if we can manage, or if we can minimize the costs, then only we can increase the profit. Therefore, to maximize profit, we should have understanding about how can we control cost. Then first we'll see what does mean by the cost. So actually the cost means that, if we consider the production process, the production process is how we convert inputs into outputs. So that is the process, that the different factors of production, the land, labor, capital, and the entrepreneurship. So those factors of production, how we convert to output. So then for these factors of production, to produce a commodity, we need factors of production as producers that we have to purchase. To say, for example, to prepare a chair. So that we need raw material, then we need the nails, maybe the equipment to shape the raw wood, then a carpenter, so then cushion. So likewise, different things that we need, like the space to prepare that chair, the place or the land. So like that, we have to purchase all these factors of production. So for that, that's the suppliers as the producers that we have to spend, right? We have to spend that amount we identify as the cost. The cost refers the expenditure incurred by a producer on the factors of production. factors of production, right? So that means if we need some to purchase some commodity, we have to purchase the factors of production. So that to purchase those factors of production, we have to incur a cost, incur a expenditure. So that expenditure we identify as the cost, right? So basically, if we consider about that cost, we can identify those costs. We can divide the cost as implicit cost and explicit cost, right? Explicit and implicit cost. So what is the difference? What does mean by this explicit cost and implicit cost? So basically those explicit cost that when we are preparing the annual reports, that means under accounts, if we consider about the accounting. So accounting, that we consider this explicit cost. Explicit cost means that direct cash payments. So that already direct cash payments, that say for example that out of your pocket, out of your pocket, that you have to incur that amount, right? That you already when you're preparing a chair, so for that you have to purchase. You have to purchase the raw woods. Then you have to purchase the nails to combine. Then you have to purchase some machineries. You have to purchase some cushions. So likewise, out of your pocket, whatever the things that you want to purchase out of your pocket, spending that you will purchase the things, those things we can identify as explicit cost. So those explicit costs are tangible in nature, and those cash payments which firms makes to outsiders from their pocket, right? Identified as example. So that in economy, total cost means here the total cost combined explicit and implicit cost. But basically, if we consider about the subject like accounts, they're really concerned only about this explicit cost. They will not bother about this implicit, right? So that procurement, likewise, some examples already given. To purchase some procurement, raw materials, payments of salaries and wages, then the transportation expenses. So those things we consider as the explicit cost. So then what does mean by this implicit cost? Implicit cost. Here that to prepare the chair. To prepare the chair, that even the carpenters also, that maybe say that you already purchased, right? But only with these raw materials, we cannot produce chair. So there may be some sort of entrepreneur, right? So he is the one already combine all these factors of production and produce that innovative product. Produce innovative product, so that you are the one, say for example, that you are the one already have this that furniture shop, that you are working there, right? You are working there, but separately that you are not receive any salary because that you are the owner of this the furniture house, and from your that you receive the profit, but for your commitment, right? For your commitment, for your time, that you are not receiving any salary. The being owner of that business, that you are doing that. So that cost, that means that if you are not engaging engage in your business, that you can do another one, right? Because maybe sometimes that you can join to the private organization, or that you can handle another business. So likewise, that you can earn if you are not engaged in the business of the furniture house, then you already have the time to do another task. Maybe that you already find out the job in private sector. So that salary that you can earn from doing the private sector job, that salary that we consider as the opportunity cost, right? Opportunity cost. So that because opportunity cost means in the first session I already explained what does mean by the opportunity cost. Opportunity cost, if you select one choice, that you have to dedicate, you have to sacrifice other alternatives. Out of that all the alternatives, the second best alternative, the value of the second best alternative, we consider as the opportunity cost. Right? Opportunity cost. So that most of the time when we are preparing the final reports in accounting, that will not consider about this type of opportunity cost or this type of implicit cost. Implicit cost. So, but in economics, we consider, right? And economics, when we are taking economic decisions, that we have to consider not only about the explicit cost, but also this implicit cost as well, right? In economics, total cost estimated considering two elements, two type of costs. Those are explicit cost and implicit cost. So that I already explained both costs, what does mean by the explicit. And here, explicit again, fall under actual, of course, normally that entered in the books of accounts, right? Payments of salaries, materials, insurance, right? All these things that cost involve cash payment and are recorded in normal accounting practices. Then the implicit cost. Implicit cost means that not take out from your pocket, right? There's no any cash outlay. There's no cash outflow, right? So therefore, that will not appear in the accounting system, right? So that implicit cost may be defined as the earning expected from the second best alternative. Second best alternative of your factors of production. Then the implicit costs are not taken into account, right? In the accounts subject that we are not calculate, we are not consider when we are calculating loss or profit in the business. But in economics that we consider this explicit cost. Right. So normally that explicit cost means the opportunity cost. Right? Opportunity cost means that may be the value of the next best alternative, right? Alternative. So that economic profit, when we are calculating the economic profit, that we are considering the values, right? The values that we forego, right? When we are taking decisions, right? When we are taking decisions in the economic cost, that we consider about explicit costs, the direct costs that we payments made by the firm to others to purchase inputs, right? Then the implicit cost like the opportunity cost, cell-phone inputs, right? That may be, so for example, if the businessman engaged in the furniture shop, so the salary for next best alternative. That means that if he can join to the private sector, so the value. Then if the owner employed his land for the furniture to prepare to establish furniture house, then that value also have to taken into consideration that that land he can rent out. So how much he can earn. So likewise, if the employee any sort of self-owned properties, resources, for that that's the next best alternative that we have to consider. We have to consider when we are taking decisions in economic aspect, right? In economic aspect. So then again, if we consider about the nature of products, so that based on the different criteria, that we can identify different types. So that earlier that based on that the cash payments or not, that we identified as the explicit and implicit cost. Then here, based on the nature of the cost, that means whether that is dealing with the selling, whether that is dealing with the production, whether that is dealing with the marketing, whether that is dealing with the finance. So based on that, we can identify selling cost, production cost, marketing cost, financial cost, administration cost. So likewise, different type of cost. So that selling cost or the marketing cost, that we identify expenditures that incur to promote sale. There may be for different propagandas, for the sales agents, then the sales commissions, then the advertisements. So likewise, to promote that, selling promotions, right? To promote that particular good, which are the costs that we are incurring, that we identified as the selling cost. Then the production cost. The production cost means which way with relate the cost which are related with the product, right? So that may be that to produce that particular good or services, the material cost, then the direct expenditures, direct production cost, raw materials, then the direct labor cost, direct other variable costs. So these things under the production, that maybe that you remember when you are calculating the prime cost of the accounting. So what are the costs that we are considering under the prime cost, under production account? So those costs, those overhead costs, those costs that we consider as the production cost. Then likewise, if we consider about the financial, so then not only this selling cost and production cost, here we identified that administration cost, that for the administration purposes, we have to maintain separate administration staff, though their salaries, so the cost for stationaries, so that the managerial level or executive level employees wages, all those things comes under administration cost. So likewise, that we can identify different type of cost. Then if we consider about another criteria, based on the time dimension, based on the time dimension, we can identify basically two type of cost: short run and the long run. Maybe that you remember how we identify, how we classified those two time periods as short run and long run. Right? That short run that we identify uh, at least there should be one fixed variable, with the variable inputs, fixed inputs as well as variable inputs. If you consider about the long run, the capacity, how they can change the variable factors of production, so that we know that within the short run, we cannot change all the factors of production. Most probably the land and the capital. It will take some time. That how can we change? How can we change all the factors of production? So that within very few time period, if you can change within 1 month or 2 months, we'll consider that also as the long run, because that supplier can change all the variables. So all the factors of production, the land, labor, capital, and entrepreneurship. So all the factors of production after 2 months. So that 2 months, after 2 months period, we consider as the long run. That up to 2 months period, we consider as the short run. So in the short run, we can identify fixed and the variable inputs. But long run, we can identify only the variable inputs. Only the variable inputs. Right? So that they relate with those short-run inputs. We can identify fixed inputs as well as fixed cost. Variable inputs, therefore, variable cost. So that if we consider about the short run, right? So the short run period, that some factors are fixed and some factors are variable. Therefore, cost have two components, that is fixed cost and variable cost. That we denote the things that you have to keep in mind. This shortened form of the cost. TC means total cost. TFC, total fixed cost. TVC means total variable cost. So then how can we derive the total cost? That is the summation if we consider the short run. Short run, the total cost is the sum value. The total cost is the sum value of the total fixed cost and the total variable cost. So say for example that if you want to calculate the total cost, the TFC is equals to 50. Then TVC is equals to 75. Then how we calculate the total cost? Total cost is the sum of the aggregation or the sum of the TFC and the TVC. So TFC is equals to 50. Then TVC is equals to 75. Then the total cost. The total cost is equals to 125. Then if you want to calculate, TFC, right, that already given the values for TC and the TVC. Then how we calculate that TFC? How we calculate the TFC? So that we want to find out TFC. Then what we should do, so TFC means TC minus TVC, right? TC minus TVC. So that now we know that what is the value for TC, 125. Then the TVC is equals to 75. Then we know the value for TFC now is equals to 50. Right? Is equals to 50. And then if you want to calculate the value for TVC, how we calculate the value for TVC? Then TVC equals to TC minus TFC. So the value for TC is equals to 125 minus TFC means 50. Then the TVC, value for TVC therefore equals to 75. So likewise, by referring this TZ equation, right? So that I already substitute by using the numerical values. Also, then if we consider about the equations, if we consider about the equation through this TC curve, that we can derive. If you want to calculate TFC, how can we calculate TC minus TVC? Then if you want to calculate the TVC is equals to TC minus TFC. So likewise, that we can derive another two equations to calculate TC, TFC, and TVC. Right. Yeah. So I referring to this one that you can have understanding about why the total fixed costs remain constant. So even though that unit of cost increase, the total fixed cost remain constant. Take the same value, because in the short run, we cannot change the fixed cost. So therefore, if we draw that total fixed cost curve, that maybe lies parallel to horizontal axis. So that under the any number of output, the total fixed cost will remain constant. That will not vary with the production, even though we produce or not. So another thing that you have to keep in mind, another very important point. Even though we produce or not, the quantity, output or quantity is equals to zero. Even though we produce or not, we have to incur that 10, this 10. So what are the values that we consider on fixed cost? Maybe sometimes, say for example, the salaries. The salaries for the administrative persons, or maybe the warehouse persons. So even we produce or not, that we have to, due to this crisis situation, that we have to stop the production. But that we have to, right? Definitely that we have to pay the salaries for the administration and for the security people, even for the production people also, at least the basic. we have to pay. There may be rent and rates. Rent and rates in Badukulisa Varipana. Rent and rates. So that if you rent a house to start up your business, the furniture house, then even you produce or not, that you have to pay the rent. You have to pay that rent. Then if you lease some sort of vehicles to transport your furniture, so that leasing payment, even though you produce or not, you have to pay. So therefore, those type of expenditures we consider as the fixed cost, right? Fixed cost, rent and rates, salaries for administration people, then the leasing payment, so depreciation, so all these things we consider as fixed costs. Sometimes the basic, the values for the electricity, the rental payments for electricity, the rental payments of the telephone, all these things we consider as the fixed costs. Then if we consider about the total variable cost, the variable cost, how we identify that variable cost? The variable cost is vary with the production. Right? That is change with the production. The producer will spend to purchase variable inputs. Right? The cost that the variable cost means expenditure incurred by the producer to purchase variable inputs, like the raw material, payments for laborers, power and fuel. So all these things we consider as the variable costs that you can see that directly change with the production, right? That is directly change with the production, right? So if you are not produce, we don't want to incur the variable cost. So no need to spend to purchase variable inputs. So therefore, that you can see how is the behavior of the total variable cost curve. So that already start with the origin. Right? The origin, that will start with the origin. So if you are not produce, no need to incur any costs as variable cost. If you are not produce. If you are not produce, the variable cost is equals to 0. Right? The variable cost is equals to 0. But when you increase the production, the cost also increase along with that, right? Along with that. That is the behavior of the total variable cost. If it is equals to 0, that means 0. If you increase by 1, is 10. For another one, so likewise 6 outputs, 38. Likewise, then when we increase the production output, along with that, the variable cost will increase, right? So then when we differentiate the characteristics of the fixed cost and variable cost, right? So that you can identify different characteristics. So the fixed costs do not change with the output, but variable cost will change with the output. And even though the production equals to 0, even though the production equals to 0, the cost remain as same. But if we consider about variable cost, if it is equals to 0, that means output equal to 0, no need to incur any cost. Therefore, variable cost also equal to 0. And when we increase the output, along with that cost, the variable cost already increase. So that's some examples: rent, permanent staff wages, license fee, right? Cost of plant and machinery. So these things considered as the fixed cost. Then the examples for variable cost: the cost of raw materials, wages, expenses on electricity and fuel. Those things we consider as the variable cost. Then if you want to calculate this by giving the numerical example, then I already explained how can we derive the functions also with relate to these calculations. So that here that you can see fixed cost takes same value, and the variable cost increase along with that, and therefore the total cost increase, but you can see the variation in the short run. Here the variation is short run is equals to variable cost, not due to this. Total cost will change. The total cost will change due to only the variable cost. The total cost will change due to only the variable cost. So that's why. That under the production theory, we consider about the shutdown point. Not the production theory, even relate to the market structures also. The relate to market structures also, we consider the shutdown point. So at least within short run, if producer cannot cover their variable cost. If they cannot cover their variable cost, definitely they have to left the market. They have to switch off from the market. They cannot survive by covering their variable cost at least, to purchase their raw material day to day, to pay their salaries for their workers. At least they cannot cover those costs, those variable costs, because in the short run, change only the variable cost. If they cannot at least cover their variable cost, they have to stop the business, right? They have to stop the business. Then here, that if we consider about 20 to 80. So likewise, if we consider the difference, that difference is equals to variable cost, because this total cost, the total cost change based on the variable cost only, right? So that having this idea, right? So that we can show the behavior of all these curves, cost curves, right? Behavior of all these cost curves by drawing all these curves in one panel. So that here, if we consider about this difference, that you can see it takes the constant, or maybe that the TC curve, TC curve parallelly. TC curve lies parallel to the TVC curve. Right? TC curves lies parallel to the TVC curves. Therefore, the gap between TC and TVC, the gap between TC and TVC be similar. Right? Be similar. So that here, the gap between TC and T, because why? The gap between TC and TFC is equals, TVC is equals to TFC. This is the fixed cost. Right? This is the fixed cost. So the fixed cost takes the constant value. Fixed cost takes constant value. So therefore, the gap between TC and TVC held constant value. The parallel is equal. The gap is equal. Gap is equal, and the curves lies parallelly. The gap is equal and the curves lies parallelly. So then if we consider about the TFC is constant, TVC increase with the output. TC is parallel to TVC because the difference shows the TFC. Right? TFC. And also we can consider here by looking at the TFC and TC, this value already this range represented by the variable cost. So here another thing that you have to keep in mind, when we are drawing, when we are drawing the curves, that you have to keep in mind that is very important. When we are moving to identify the marker structures for fit. Right? Marker structures for fit, how we draw the total cost curve. Total cost curve. So that you have to keep in mind the total cost curve will start having intercept value. Here we call this one antakande. Having intercept value. Having intercept value. Here already the intercept value is equals to 10. Why is that? Because the fixed cost. Because the fixed cost equals to 10. Right? So therefore, even though we produce or not, that we have to incur some amount, then the TC curve or the total cost curve. Therefore, the total cost always start having intercept value. Right? With the intercept value at the total cost curve originate. Because there's some amount as the fixed cost. Right? Some amount as fixed cost. Then under the cost theory, or the cost concept, basically that we have to learn, we have to focus about these three basic concepts. Right? The first one is the total cost. Total cost. Second one is the average cost. Third one is the marginal cost. Marginal cost. මුළු පිරිවැය සාමාන්‍ය පිරිවැය සහ ආන්තික පිරිවැය. So that total cost means that we know the total cost means how much the producer incur to produce the total output. To produce total output. That is the total cost. Then if we consider about the average cost. So average cost. So that means always average is dealing with the per unit. Per unit to produce 1 unit. Here the average cost means per unit cost. Right? Per unit cost. Per unit cost means to produce 1. If you know about the total cost, then along with that the number of production, then very easily we can calculate the average cost per output. Per unit cost. Then to produce one commodity, how much we incur as the cost. That we identify as the average cost. Then the marginal cost. Marginal cost. So the marginal cost means the additional. Okay. Additional cost. Or the extra cost. Additional or extra cost. So if you want to produce 1 more unit, additionally how much you incur as the cost. Right? So here that average cost, say for example, to produce 100 units, that have to incur 3 lakhs. 3 lakhs. Then if you want to calculate the per unit cost, what should have to do? 3 lakhs, we have to divide by 100. Then how many per unit that we have to incur? 3,000. Right? 3,000. So that means if we substitute the values, the letters, as a function that we can write down average fixed cost. How we calculate the average fixed cost? That is total cost divided by number of outputs. Right? Then what does mean by this marginal cost? This marginal cost or the additional cost. So if we produce, for example, quantity and total cost. So for one product that we have to incur 100. For the second product, totally that we have to incur 120. So then to produce extra unit, 1 to 2. To produce extra unit, how much that we have to incur additionally? Additionally, that means 20. Right? So as additional cost that we have to incur 20. So that as marginal cost that we can identify 20 units. Right? 20 units. Then we see that if you ask to calculate the average cost, right? Average cost, that average cost is the per unit cost. Per unit cost. Then how we calculate? TC divided by Q. Right? So otherwise AFC divided AVC. So that here that if you want to calculate the average cost, the total cost, that you can derive. You can divide the total cost from the number of outputs. Right? Then average variable, here the average cost, then we can know, we already have idea about that. How can we calculate the total cost? Total cost is equals to total fixed cost divided by total variable cost. Then if you want to calculate average cost of both, the average TFC divided while dividing TFC by Q and TVC by Q, we can separately calculate how much the average fixed cost and average variable cost. In calculate average cost, right? And calculate, then calculate the average cost. Then how do we calculate? Separately. This is the fixed cost. If you want to calculate average fixed cost, then you can divide from the number of output, TFC divided by Q. Total fixed cost divided by Q, right? Average fixed cost. Then if you want to calculate the average variable cost, right? Average variable cost, how can we calculate average variable cost? So the average variable cost, this is the total variable cost that divided by number of outputs, right? ABC is equals to TBC divided by Q. Then after having that value, after having those values, if we draw, right? If we draw the curves along with that, so that you can see what had happened to the average fixed cost. What had happened to the average fixed cost, that you can see that is gradually decline, right? Gradually decline. So that if we draw the average fixed cost, what happened? What happened? That will gradually decline. So the reason is actually that, say for example, if the T total fixed cost is equals to 100, then if you produce 100, then the 100 with the 2, maybe 50. So likewise, the fixed cost, the fixed cost will be divided among the number of units. That will be distributed among the large number of output when we increase the output. So therefore, the average fixed cost, right? Therefore, the average fixed cost gradually decline. But you have to keep in mind that the average fixed cost never touches this horizontal axis. Never touches this horizontal axis because there are some value. There are some value as the fixed cost. So therefore, that may be not equals to 0, right? Not equals to that any number of value that may be give the 0.99999 likewise, but that not equal to 0. Right? So that this shape, this shape, we call the shape of the curve, we identified as the rectangle hyperbola. Rijikonastrākara bahuvale. AFC curve is the shape of the AVC curve. The shape of the AVC curve is the rectangle hyperbola. Okay. The rectangle hyperbola. So that means the shape of this curve, right? ඍජුකෝණාස්ථාකාර බහුවලයක හැඩය ගන්නවා. So then if we draw the average variable cost, what happened to the average variable cost? So that it's gradually decline. It's gradually decline and come to the minimum point and then again tend to increase, right? Tend to increase, right? Because that actually, that means that already take U shape, right? Takes U shapes. So if we consider about the consider about marginal cost, additional cost, that already I explained what does mean by the marginal cost. Then if we write down the calculation equation, delta TC divided by delta Q is equals to marginal cost. I already explained that. So that then if we draw the average cost curves, average cost curves by considering the numerical values, right? That AFC, the shape of AFC, that you can see that it's like the rectangle hyperbola. Right? So rectangle hyperbola. But if we consider about other two curves, what had happened that already decrease up to some extent and reach to the minimum point, then again tend to increase, right? The short run cost curve, the short run average cost curves, therefore takes U shape, right? Takes U shape. So what is the reason? What is the reason for that? So that we now I think you all have the idea about the production theory. So if we draw the total production curve, can you remember that that will increase with regard to short run? With regard to short run, here that already increasing at increasing rate, and to reach increasing rate and gradually decreasing rate, and anyhow reach to the maximum point. Reach to the maximum point and then tend to decline. Why is that? And you remember the reason? Can you remember the reason? Because of the diminishing marginal productivity. Diminishing marginal productivity. හීනවන ආන්තික ඵලදායීතාවය නිසා තමයි so that total production curve, TP, total production curve, in the shape of the total production curve. So that here that gradually increase. So that means if we add more and more variable inputs to the given fixed input, if we add within the short run, in the short run, if we add more and more variable inputs to the given fixed inputs, what will happen? The marginal productivity, initially marginal productivity will increase, then come to the maximum and then to decline. So that's simply if we consider the diminishing, due to diminishing marginal, why it decreased like this? Due to diminishing marginal productivity. If we add more and more variable inputs to given fixed inputs, the marginal productivity gradually decline. That concept we identified as the diminishing marginal productivity. So therefore, the cost curves are mirror images of the pratibimbane. Mirror image of production curves. So that when the production increase, the cost will decrease. When production comes to the maximum point, the cost also reaches to its maximum. When the production tend to decline, the cost also increase. So that mirror image, the cost curves are mirror images of the production curves. And why the short run cost curves take U shape? Why short run cost curves takes U shape? Due to this diminishing marginal productivity. හීනවනාන්තික ඵලදායීතාවය නිසා, right? The short run cost curves takes U shape due to diminishing marginal productivity theory, right? If we consider about the shapes that you can see when AC declines, MC declines, then likewise that you can have the idea about the short-run cost curves. Then FC gradually decline but never touches the horizontal axis, and the AVC and the gap may be reduced. You can see the gap will be reduced because the difference between AC and AVC is AFC. So the gap will be reduced gradually, but never touches these two curves because they are some value for AFC. Therefore, these two curves will never touches. Right? So the list of formulas that you can refer, this list of formulas, and we relate to this that you can have idea about the how can we derive TC if the TC given A plus BQ to the power then maybe 0.10Q3 to power like this, then how can we derive the fixed cost, variable cost, then through that AFC, AVC, MC, all these things, right? So you should have to do some sort of calculations, right? Then if we consider about the long run, then the long run cost curves also takes U-shape, right? Long run cost curves also takes U-shape. So why is that? Due to these reasons. So long run cost curve, right? If we draw the long run cost curve, that you can see that may be covered, right? That already cover all the short run cost curves. All the short run cost curves, therefore, that we identify this curve as the envelope curve as well. Yeah, envelope curve. Right? Envelope curve, because that will cover all the short run cost curves. So why? There's two different reasons. Right? Two different reasons for the shape of the short run cost curve and the shape of the long run cost curves. Both are takes U shape, but the reasons are different. So due to economies of scale and diseconomies of scales, right? Economies and diseconomies of scales. There are different economies of scales like this and different diseconomies of scales, right? So that due to this reason, the long run cost curve takes U shape. So that I think through today's session, you already have the good understanding about the cost theory, right? About cost theory. Then we'll meet again by another online session. So thank you very much for your attentive listening.